Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about support and resistance trading that actually works. Okay, so most of the traders, most of you guys, I'm pretty sure when you got started in Forex trading, one of the first things you learned when you're trying to learn about technical analysis and how to identify when to buy or when to sell, or exactly where to buy and where to sell, you must have come across support and resistance because it's quite a widely used concept in trading in general, not only forex trading, financial markets trading entirely. Okay, so I know you've probably come across it, but you might have come across it in the way that is not really effective. Okay, and that's what we're trying to fix in today's class. So we're actually going to be talking about how to trade it properly, how to use other techniques which have been proven to work, and layer them on top of it so that you can improve the percentage of you trading it in a way that works out. Obviously, like if you've been attending these classes for any considerable length of time, you know that I'm the first to always tell you that there's nothing that works in the trading markets 100% of the time. And in fact, we don't need anything to work 100% of the time, because if we can practice proper risk management, have a rock solid bulletproof mindset, then even if we're right like 30 or 40% of the time, after we take a large number of trades, okay, for example, like 100 trades, for example, with good risk to reward ratios, positive risk to reward ratios, obviously, meaning we're risking much less than what we are aiming to make on average, and then we're doing that with a trading methodology that gives us an edge, a repeatable edge in the market, then we're obviously going to end up being profitable. We don't need to do it, we don't need to, technically speaking, be right 100% of the time, okay, with that in place. So without wasting any more of your precious time, let's dive right into it. Okay, so in its basic form, what is support and resistance? Well, I want you to think about support and resistance like you would think of the ceiling and the floor in a particular building that you're in. Okay, so think of the support as a floor. Okay, and just to make this easy for you to understand, let me illustrate it using a whiteboard or a blackboard. It doesn't really matter. Okay, so think of support, like I told you earlier, think of support as the floor you're standing on. Okay, so if this, and this is my attempt at drawing you, okay, so apologies because my artist skills, I think I must have left them somewhere. So assuming this is you and this is the floor you're standing on, obviously, then without this floor, you're not going to be able to find the the solid ground that you need to stand upon without falling, or diving through the earth's surface, or whatever the case might be. Okay, and then think about the ceiling as something that protects you from the top. In this case, obviously, we're talking about the market, so we're assuming that, let's say you're a Superman and you can actually fly up to the sky and all of that. The ceiling hopefully is going to protect you from doing that and just keep you contained. Okay, so in the market, this is kind of the way support and resistance work. When price is moving in the markets, usually when it reaches a point where it can't move any further, regardless of whether that's a straight line or diagonal or whatever the case might be, whenever price is moving in one direction and it just bumps onto a particular level or an area where it finds it difficult to continue moving in the direction that it was moving in previously, if it was from the downside to the upside, that would be labeled or regarded as a resistance area. Now, if it's to the downside, for example, price was coming from up there and coming all the way down, and then it bumped into an area where it couldn't move any lower. And so when it bumped into that area, it bounced above it, and then it maybe temporarily stalled or reversed from that area, whatever the case might be. It's just finding it extremely difficult to continue moving to the downside. That is known as support. Okay, so when price is coming from below, trying to push high and continue moving up, and it fails to do that, the area or the region where it's finding it difficult to continue doing that is referred to as resistance. While when it's coming from the top and trying to go to the bottom and it finds supports there, so that it can't continue moving any lower, and it just bounces off of that level and tries to move to the upside, either it be permanently or temporarily, that is known as support. Okay, so when we go to our price chart, let me turn off the whiteboard here. When we go to our price chart, you can see this is what we have here. Okay, so this is a cool example of this on the chart of the GBP JPY currency pair. Obviously, this is the weekly time frame. Okay, and you see the reason why I'm using a very high time frame like this in a moment, but this is just to drive home my point. Okay, so here you can see that when I draw this line here, you can see that there were a number of times that price was moving up. Okay, moving up, moving up, moving up, moving up. Okay, and then it just couldn't move any higher than this area. Okay, this area you're seeing here. Okay, it just couldn't move any higher than this, and then out of the blue, from all the way up here, it just came crashing all the way down here. Okay, now this, based on what we've just talked about, the definition that I just gave you an example, this would be regarded as a resistance area, because for whatever reason, when price came to this level, it just couldn't keep moving up above this area. So it bounced off of this level and it came crashing down. So this is going to be regarded as our resistance area. And then this area right here is going to be regarded as support. My drawing is a bit messed up here, so let me quickly do this. Okay, now you can see that price came all the way down here. Some traders like to use the very tip of the candles that they have on their charts to draw the areas of support and resistance. I personally don't do that, because I feel if it wasn't strong enough to close at that level and it ended up forming a wick, then maybe the momentum was just not too strong at that particular area. And so I prefer to use the bodies of candlesticks, which is where price actually closed. Okay, where the bulls or the bears in the markets that were pushing or controlling prices, where they were strong enough to hold it so that it closed at that area. I use that particular area, the closing prices, the bodies of the candles, as where I use to draw support and resistances. Okay, so in this case, you can see that instead of drawing it with this, I drew it somewhere close to this area. There's no right or wrong way to do this, okay? This is just telling you one of my preferences for doing this. And if I was to go with this again, you'd see that this would be where I would be drawing the one on the top. So there's no right or wrong way to do this. It's just, it all boils down to preferences. The reason why I did this is because I wanted to draw your attention to the fact that if we were using the tip, okay, this and this and this area, you could see that price came here multiple times trying to keep moving to the downside, but it failed. And so when it retested this area again, it failed to break below this area. So you could see clearly that this area is actually it's reacting, okay, to price action. Okay, so for whatever reason, price cannot just continue break below this area to continue moving lower, for whatever reason that might be. Okay, that's best known to the market. But again, this is just something you take note with support and resistance. Okay, so now we've got this area. Price came all the way down here. It got rejected. It couldn't continue moving any higher. So we had a little, pull back. We had a kind of like a little push up bounce from this support area. Just think about it like you're throwing a ball on the ground. Okay, let's say, of course, this ball, because it's called a ball, it's bouncy and all of that. So when you throw it on the ground, it just bounces off of that level and continues moving. Okay, so you could think about it the same way. Price came with this strong momentum from all the way up here, and then it paused in and around this area where repeatedly it tried to break below and it failed to do so. So when it came to this area, it bounced off of it, and then it tried to break below the area again, and it failed to do that, and then it bounced off of this area. So it kept doing this up and down, up and down, up and down, and then anytime it comes to this area, for whatever reason, it bounces off of it and it goes up. Now, in simple terms, this is kind of like the premise behind the logic behind support and resistance trading. The idea is that since there are areas or levels or zones, whatever you choose to call them, it doesn't really matter, okay? Since there are areas on the chart where price comes to that area and then it finds it difficult to either break above the area to continue moving up or break below it to continue moving down. And so whenever it comes to that area, it reacts to it. Either it comes to it and it bounces away from that area to continue moving in the opposite direction, or it bounces from the top to the bottom. Okay, because of that, the logic behind that is that because that has happened a few times in the past, we are banking on it to happen again. And so since we are banking on it to happen again, we're going to capitalize on that so that if it does happen again, we're going to profit from that occurrence. Okay, remember, we want an edge that is going to be repeatable in the market so that we can take advantage of it whenever it presents itself in the market. Okay, so again, let's move on to, let me quickly clean some of the drawings I did here so that we can easily understand what I'm talking about. Okay, or let me just clean everything. Okay, and then use the tools inside MetaTrader to draw our lines and all of that. Okay, so this is the line I want to draw your attention to here. Okay, this area, and I'm going to color it something that's going to be easy on the eyes, easy to find, easy to see. Let's just go with a black color, and let me make it a little bit thicker so that it's going to stand out on the charts. Okay, if I'm using the bodies like I said earlier, you can see that for this particular move, price has reacted to this area multiple times. So before it broke above this area, okay, it came, bounced off of it, came down, came, bounced, tried to break above it. It even closed above it, but it couldn't quite keep the momentum, and so it bounced off of it after the false break, came down, then it broke again, did a false break again, and then eventually it moved up. And then you can see that I told you multiple times when it came to this area, it couldn't break below the area, it just found support. And this reminds me of something. In technical analysis, when support is broken, that support is expected to become resistance when price comes to that area, okay, eventually. And when resistance is broken, again, it's also expected to act as support when price comes to retest it in the future. So in this case, you can see that this area has been acting as resistance 1, 2, 3 times. And then eventually when it broke above this area, it acted as support because you can see this bearish candle couldn't break below this area. And then it bounced and went all the way up, only for price to come back to test this area. And the area kept acting as support, and then price bounced off of it. So when support breaks, it turns into resistance, and when resistance breaks, it switches roles, okay, and starts acting as support. Now, for this particular example, assuming you've learned that, okay, whenever price comes to an area on the chart, support and resistance, it either breaks above or below that area and continues moving, or it reacts to the area and bounces off of it. So if you're anticipating that, okay, based on the reactions that price has shown to a particular area in the past, it's likely that it's going to bounce off of it, what's the smart thing to do in that case? The smart thing would be for you to position yourself in such a way that you take advantage of that particular thing, that occurrence that you are anticipating, so that when it does happen, you're actually going to be in the green. You're actually going to make profits from it. So in this case, the one that I'm going to be using as an example for you is let me quickly pick any of these tools so that I could, the shapes, okay, excuse me just for a bit. Let's use the rectangle tool. I want to map out this particular area on the chart. Okay, so this area, why is it of importance for me? Okay, why is it of importance? Now, when we go back a little bit, you notice that price has been struggling. Remember, I told you price has been struggling to break above this area, and then whenever it came to the area, it bounced above, it bounced below at the area and bounced down. Tries again, fails. Eventually, when it did break above this area, remember what I told you about resistance turning to support. So when it broke above this area, it now turned into support. So it came all the way up here, and then when it came here, it bounced off of it. So now that we've had it multiple times, price has been reacting to this area. When we would have seen these candles, these red candles coming back down here, we would have been eager to see how price would react to the area so that we'll take a trade in the direction of the bounce if it was to bounce from the area again. So now that I've drawn this particular thing here, this rectangular box here, we're going to go to the lower time frames. This is the one, the weekly time frame, obviously. So we're going to go to the lower time frames to have a clearer view, a zoomed in view of price action. Okay. So here, let me turn this off, and so that we can try to locate the box that we drew. Okay, the rectangle. So let me go to show, so that we have a rectangle showing on the charts. Let's see. Let me zoom out a little bit. I think we've gone so far out that we can't even find it here, because it's been a really long time. Okay, so let me see. Okay, let's use the daily time frame, which would not be that bad in this case, because we're going from the weekly to the daily. Obviously, yeah, this is good enough. So what I want you to pay attention to is the fact that, you see, price tested this area previously, and then it bounced off of the area. Remember, I told you it's like a ball. Just think about you throwing a ball and it bounces off of the floor and just keeps bouncing. Okay, so here price came to this particular point, and then it couldn't continue moving any lower. Okay, because there was maybe strength in the bears on the market or whatever, or the bulls just hijacked the market or whatever the case might be. Okay, so here it came, bounced off of this level, and then it started moving to the upside. Now we would have been waiting for it to come back, because obviously this area has been heavily contested by both the bulls and the bears in the past. And so when it came back here, and you saw that, okay, we had this long bearish and long wick candlestick, okay, showing us that when price came to this area, it was heavily rejected. The momentum that was there to continue pushing price lower was not strong at all, and so that was why we had the formation of this very long wick. And then we had something like a bearish engulfing candlestick, but the momentum couldn't keep going lower. All of a sudden, we switched from forming the momentum of a stronger bearish engulfing candlestick to now price getting rejected over and over and over, forming these long candlesticks till the time where we got the formation of this bullish engulfing candlestick right here. Now in this situation, this would have been our cue at the close of this candle to go long on this pair with a stop loss below here, because for whatever reason, if after taking this trade, because we are anticipating that price is going to bounce away from this support area, if after taking this trade, price comes all the way down and breaks below this low, then the trade is no longer valid, because the reason why we're taking the trade in the first place is nullified. And so if we are taking the trade at the close of this bullish candlestick with a stop loss below here, this trade would have obviously worked out. And this is a kind of a support and resistance trade, because if we would have taken the trade here, our stop loss below here, and we're aiming for, let's just say, a modest 1:3, 1:4 risk to reward ratio. Even if we're going for a 1:5 risk to reward ratio, price would have easily hit this profit target. And the beautiful thing about trading with this support and resistance techniques is that it doesn't need to be only on the higher time frames. The examples I showed you here was using the weekly time frame and the daily time frame for fine-tuning our trade entries. But this doesn't mean that it has to be on a high time frame like that. It's just that with the higher time frames, especially anything that's above the 1 hour chart, for example, okay, you tend to get much more reliable trading signals. Okay, but the downside to trading with those higher time frames is that it's obviously going to take a lot longer for price to hit your profit targets. So in this case, even though it looks awesome, you might have taken the trade here and then you would have hit it, price would have hit your 3-hour or 4-hour profit target. Just look at how many candles you would have taken. So it would have taken you nothing less than 1 or 2 weeks, because each trading day, each trading week in this case would be like 5 candles, for example. And here you can see that it took multiple candles before price hit your profit target if you were going for a 3-hour trade. Okay, and this is actually one of the faster ones that I've seen. And so you need to consider the type of trader that you are. If you don't like holding trades for so long, you're not a swing trader by heart, then obviously you could use this technique with the lower time frames. Okay, maybe use the 1 hour time frame to map out your zones, your support and resistance areas where price reacted in the market and all of that, and then use the lower time frames like the 15 minutes or the 5 minutes or whatever to fine tune your entry. And then hopefully, because you're trading the lower time frames, your trades would be in and out, with this fast. But then if you're trading the higher time frame, it's obviously going to take a lot longer. Okay, so this pretty much brings us to the end of this week's edition of the class. What I would want you to do is not to just, fold your hands and after watching this, just go out there and, forget about the class that we just had. Is for you to go to the markets, go to the charts, whether it be on TradingView or whatever charting platform you're using, and then eyeball these moves a little bit, map out some zones on the charts, look at how price reacts to it, identify trade setups, and the ones that you would have taken and the ones you wouldn't have taken. And when you have, solidified a couple of rules for your trade entry and exit and risk management and all of that, then backtest that with proper backtesting software. Okay, to prove to yourself that it actually works before deploying it to the markets, maybe on a small live account or whatever the case might be. But you need to test it out, prove to yourself that it actually works before putting any real money behind it. Because if you do anything otherwise, then you're not doing it the smart way that professional traders would approach it. Okay, so before we wrap up the class, I would like to again use this opportunity to invite you guys to try out our ITU suite of bots. We've got the ITU Goldmine, the ITU ABT, the ITU BBT. All of these expert advisors, or robots as they are more commonly known as, which are designed to identify low risk, high probability trading setups for you, place those trades on your behalf. If you follow our risk recommendations, they would actually place the trades for you with proper risk management and then get you to start earning while you're learning how to trade. So if you're interested in any of them, please feel free to reach out to us on any of our social handles or drop a comment in the comment section, and then we'll be more than happy to assist you, show you step by step how to set everything up and get you up and running in as little time as possible. And that's pretty much it for this week's edition of the class. So once again, thank you for taking time out of your busy schedules to attend this class. I look forward to seeing you guys in next week's edition, and have a wonderful rest of your week, and God bless you all. Cheers.